What is earnest money and what are the contingencies of a transaction? Earnest money is a deposit of funds, typically 1% of the sale price of the home, that's kept with the title company throughout the transaction. There are a number of contingencies within a transaction that allow a buyer to terminate to get that earnest money back. One of the contingencies are the seller's property disclosures. Every seller in Oregon that has lived in a home is required to provide the buyer with property disclosures, everything they know about the house. In Oregon, buyers have 5 calendar days to terminate a transaction based on what's found in the property disclosures. One of the most important contingencies is your inspection contingency. In Oregon, a buyer typically has between 7 to 10 business days to do their inspection, get any bids needed for repairs, and then negotiate those repairs with the seller. When a buyer is negotiating with a seller during their inspection period, there are typically 3 chips that a buyer has at their disposal. The first chip would be to lower the sales price of the home to account for any of the repairs needed. The second chip would be to have the seller have repairs done prior to closing. The third chip is called a closing cost credit. When a buyer is purchasing a home using a loan, they typically have between $8,000 and $12,000 in closing costs. These are costs that are on top of their down payment. Closing costs are calculated by adding the principal of the first year of your loan, the interest rate of the first year of your loan, the property taxes on the first year of your loan, and the insurance for the home for the first year. Those are all bundled together to create what's called closing costs. With these closing costs, you can have the seller cover up to the entire amount of the closing costs in order to account for any repairs needed. Another bargaining chip that a buyer has at their disposal is what's called a rate buydown. A rate buydown is when the seller contributes a certain amount of money towards the interest rate payment for a buyer. What that does is it lowers the interest rate payment for the buyer, typically for 1 to 2 or maybe even 3 years. With a lower interest rate, what you're doing is you're lowering the monthly payment for the buyer. So it makes the buyer's payment more affordable for 1, 2, or even 3 years. Another contingency in the transaction is the appraisal. If you're buying a home using a loan, the bank is going to require the buyer to get an appraisal done on the home. As long as the home appraises at or above the sale price of the home, the bank will finance the deal. If the home appraises below the sale price of the home, then the bank will not fund up to the sale price. They'll only fund up to the appraised value of the home. If that happens, the buyer has a contingency to back out of the transaction for a low appraisal. Another option the buyer has is they can negotiate the price difference, whether that's the buyer coming up with additional funds to match the difference between the sale price and the appraised value, or the seller is accepting to sell the house at the appraised value that the bank will purchase it for. Earnest money is negotiable. Typically, it's 1% of the sale price of the home, but if a buyer wants to make their offer stand out, they can offer as much earnest money as they want. Earnest money is not additional funds. Earnest money is a portion of the buyer's down payment. So if you're buying a $500,000 house and you put down $5,000 of earnest money and your down payment is $25,000, the remainder of your down payment would be $20,000. Once the buyer has exhausted their contingencies, the earnest money would go to the seller if the buyer decided to terminate the deal. This is a security for the seller to ensure that the buyer will not back out of the deal at the last minute. So if the seller has made a large amount of repairs, has made plans to move out, if the buyer decides to back out after the contingencies are exhausted, the seller would keep that earnest money as a protection for them.